So this is the midnight opening range. So the first thing you got to do is obviously find electronic trading hours. So for the folks that don't know, I don't necessarily know what plan you have to have for TradingView. So to avoid the idea that I'm trying to sell or getting any kind of affiliate marketing type thing from TradingView, which they offered it to me, I declined it. I don't do any affiliate marketing because that way my opinion is 100% organic. It's not influenced by anyone. I'm not paid to say I like something or don't like something. If I say I don't like something or I like it or I don't like it. And it's just simply that. So I don't know what plan you would have to pay to have TradingView offer this for intraday charting when you're looking at index futures. I don't know, to be honest with you. I have the highest form of plan at TradingView. So I have the Pro platform. So I can see things that maybe your plan, or if you don't have a paid plan for TradingView, you may not have this option. And there's nothing I can do to correct that for you. Okay. So just know that I'm being honest with you. I'm being sincere about it. I don't know personally what plan would offer this if it requires you being a paid member of TradingView. So just bear that in mind. I apologize if that's offensive or if it makes you mad, but I don't have any control over that, okay? So you're gonna be looking at it through electronic trading hours, okay? And by having that, you're gonna be able to see basically, Globex hours trading. That means the off session or non-regular trading hours. When you have it on electronic trading hours, what you're gonna do is you're gonna grab your vertical line here, and you're going to find midnight. And you always have to make sure that your chart is set to New York time. I don't care where you live geographically on this spinning rock that we call Earth. You always have to set your charts to New York local time because everything runs by this algorithm on New York local time. Whatever it is in New York time, that's what your chart should be set to, so you can see everything based on algorithmic delivery. Anyone tells you other than that, they don't know what they're talking about. If they talk about algorithms and they're not specifically talking in Eastern or East Coast time, they're completely oblivious and they don't know what they're talking about. Just run away from them because they're frauds. So at midnight, we have this beginning reference point. So that's the beginning, and this is the end at 12:30. So you find 12:30 on a 1 minute chart right there. See that? So now all you have to do is find where is the opening candle at midnight right here. That candle, the low, and the high. There's 3 reference points there that are very, very crucial to me as a trader. So when I coded this algorithm, I wanted to have the benefit of having the parameters of a daily high, a daily low, and that way I can find the plethora of setups between those 2 daily range extremes. So that means I could trade with the idea that I know it's likely to reach to this degree of price because it's going to be the high of the day. And I can trade to this degree of price because it's going to be the low of the day. And while I'm in between both of those reference points, if I know what time of day it is, I know how I can implement the meat basically on that bone between the high and low of the day. So there's a plethora of setups in between those 2 reference points. Now, it's not my goal to teach you how to pinpoint the daily high and low, but I'm going to give you some hints like I did to my paid membership students in the 2016-2017 mentorship, where I was teaching them daily high and daily low. Now, there's a lot of things that go into that. And again, I'm not going to just simply divulge that because that is such a degree of there's no competition when you have that. Like, there really is no competition to it. But you don't need to know the very high or low of the day. But you can anticipate a rough idea where that might be a couple times a week with what I've already taught on my YouTube channel. And I'm going to give you some more information here. So it kind of like will help you if you have all my old videos from Baby Pips days. You can go back and use this idea here and back test and see exactly what I was doing. And it was just like I'm showing you here tonight, okay? So what 3 reference points are we looking at? Well, the first thing is the opening price at midnight. On this candlestick right there, I'm going to plot that like that, and let's widen this up a little bit so we can see that range a little bit better. And I have to be careful because if I'm not, this could be very easily another hour-long video, and I don't want to make a long video because I know the attention span of new students isn't that long, and unfortunately they sometimes lose interest and they don't ever really get the chance to appreciate what's being shared. So we have this level here, and I'm going to thicken that up. You don't see it, but I have this little recording thing. It's always in my way. And then we're going to clone that. And we'll plot that right there on the low. Okay. So now what I have here, and I'll make this a little bit thicker as well and make it black. There you go. And I'll change that to a dashed line. Okay, so that's the midnight opening price for Power 3. Power 3 is your daily range candlestick formation. This high is the midnight opening range high, and this is the low of the midnight opening range. Okay, so this information, once you have it, it provides a great deal of insight. Okay, and if you look at what I was doing in the trade last night with my son Caleb, all of this move here, I anticipated that and was showing you where it would draw down to. And it's really based on simple liquidity. This low right here, right in here, this inefficiency, this is buy side imbalance, sell side inefficiency. And then we have the liquidity resting below here. So these are all draws in liquidity, and I was mainly using this frame of reference there. So if we go back over here, once we have this information, I'm going to take these lines that are vertical off. Okay, so you don't no longer need them. But now you know what it looks like and how to frame it yourself. In this drop here, from the high down to the low of the midnight opening range, I want to look for inefficiencies, order blocks, breakers, any PD array that I've taught in month 4 content of my paid membership and mentorship lectures. The way you look for that on the YouTube channel is go into 2016 ICT private mentorship playlist and look for month 4. And I'll go through in that number of videos, I go through my PD arrays, the first introduction of going through them. Not all of my PD arrays are taught in that playlist, but the majority of them are introduced there. Not all 81 of them. So if you notice this level right here, this single candle right there, that is your first reference point where the largest degree of displacement takes place. Notice that? Now, sure, we had a SIBI over here, but this one right here, much more pronounced, okay? Much more prominent. It really jumps off the chart. So by having this and measuring that inefficiency, we can now have a graded inefficiency that can be utilized. Oops, I just grabbed the wrong thing. We can use this information and go forward by having and real quick, last night I taught you that, see how this closing price is below the next candle's opening price here? You see that? So this candlestick's close, the bottom end of the body basically, that is lower in value than the opening price of that candlestick. So that's why I'm putting that shaded box on the wick of this candle and not this close, okay? And the same thing over here. This candlestick's close is lower than this candlestick's open. So there's no volume imbalance is what I'm basically getting at. If there's a volume imbalance, you have to make sure that you encapsulate the SIBI or buy side imbalance, sell side inefficiency, BISI, which would be the opposite of this. This is a SIBI, one single candle that's bordered by previous candle that doesn't share the same range, and a subsequent candle that doesn't share the same range of this one single pass through on here. Okay, so now we have this extended through, and now this displacement, the algorithm will refer back to that. It'll go right back into that range. And how will it use it? Well, we have gradient levels here. The lower quadrant, consequent encroachment, which is the midpoint of the range high and low that creates this single sell-side imbalance, buy-side inefficiency, and the upper quadrant level here. And then obviously the high and the low respective of this inefficiency. Now, by having this information, we can go forward and use things like fibs that give you mathematically derived projections to where the daily highs and the daily lows will form. Now that sounds crazy, right? Like there's no way, come on ICT, you can't do things like that. Well, you can't, but I can. So if you take the high here of that opening range at midnight, and we plot that like that. You see that? Now I'm going to go into the settings. So you can see again, here is my Fibonacci settings. And if we add things like negative 0.5, negative 1, things of that nature, we can get projections that will take us above these relative equal highs. How high can it go? How high can it go if it's going to sweep above this level here? And how low can it go when it starts to break lower should it do so? Well, if we scrunch this thing up here a little bit and we apply the fib both directions. So here's negative 0.5 and then negative 1, and then we have the standard deviations that are projected lower down here. And now we have things that we can project going forward. We have some relative equal highs up here, so there's buy-side liquidity. And we can anticipate price running up into these levels here, and then we have standard deviation negative 1. Now, what is that measuring? Like, what is it that you're actually getting from that? You're getting the range low of the midnight opening range, that 30-minute interval between midnight and 12:30 Eastern time. If the market trades above it, then it can go 1/2 of one standard deviation or 1 standard deviation. So in other words, the actual range from the high to low, that range added to the high. That's all it is. So think like measured move. How hard and fast it goes to that degree of premium or discount is relative to an economic calendar event during London. Okay, so this is all helping you trade London session. That's what it's really based around. And I'll give you some more details in a moment. Just bear with me, okay? These are very, very complex concepts. So when I sat down and I was coding all these things to make it fashionable, where knowing what it's going to do, repeating it, and how it's going to refer back to same reference points and over and over and over again, that is something that I can't obviously teach and showcase in a video. Certainly not going to do it on YouTube anyway, but just to give you the nuts and bolts, if you will, this is a very easy brass tacks approach to finding the 1 or 2 levels that generally, not all the time, but generally will deliver what you're going to be looking for a daily high or daily low. We have relative equal highs over here. You see that? So this one here is enough to do that. It trades up into it there. But then we have standard deviation 1 up here. So watch what happens later on in the day session. But for right now, I want you to look at what we have in London. Okay, we have the standard deviation based on this inefficiency. If we take the range from low to high, that's this low here to that high, 1/2 a standard deviation, 1 standard deviation. If we use the inefficiency, we can do the same thing there, where we can take those levels and now we'll plot them from low of the inefficiency to the high. Now I already know, okay, I already know that there are very, very critical minds watching this, and they're saying this is overcomplication. Okay, I already told you that it's just something that it's not found in other books. No other educators, Gann doesn't know about it. Wyckoff sure as hell didn't know anything about this. Larry Williams doesn't know anything about this. You know, nobody else knows this stuff because you're talking to the Mac Daddy who put it together. So this inefficiency here, if we use that same idea of standard deviations from that, we can also get very, very precise elements to how the algorithm will rebook and redeliver to premium and discount, even inside of that midnight opening range. What do I mean by that? Well, this is first presented displacement. Okay, the displacement in and of itself is a PDA array. Remember, we already had a inefficiency offered here. Okay, so it's not that it's, you know, sell side imbalance in of itself. It's a very large one, and it's occurring inside of the midnight opening range. So it jumps off the chart. It's the first presented displacement. Notice that? So what happens when I add these same levels that are here, -1 and -0.5? What if I add that to this inefficiency on the upside? Well, you get these things like this. You get the 50 or half of it. That's this level here. Look what the bodies are doing. You see that? Look at all this. The close of that candle, the open of that candle, all this consolidation around there. Look at the bodies here, here, and it moves away from it. And then we have the -1 standard deviation here. What is it doing? It's creating this delivery of that high. Look at the bodies working around that and all the consolidation around here, and it runs away from it there. Now, what happens when we use this same idea and we add it to the projection below this inefficiency? You start from the high down to the low. -0.5. You can see how we're working this level here, and then finally at -1 standard deviation, we see it here, 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 and then rallies and starts working inside of that displacement in and of itself. So we can see there's boundaries that can be created with this. So the markets are absolutely not random. And you're going to try to argue with me and tell me that, you know, all the buyers came to the conclusion that this is a good time to buy, and sellers said, no, we're not interested in selling anything lower than that. So therefore the market stopped, turned on a dime, and reversed, right? Wrong. Same thing here. The market's just going to randomly go down to that level here, stop, turn around, and go higher simply because sellers are no longer interested in going short, and or buyers overtook the buying or the selling of short sellers. That's not how the markets work, folks. Okay, and for the folks that are leaving comments and saying, you don't even know how the markets do auction. You don't know auction theory. You don't know algorithmic price delivery. That's the problem here. There's a break in communication here because you don't know the language of the marketplace. You can read all the books and listen to all these people talk about how they used to work on the floor and they knew this and they knew that. These same people are in my mentorship. Okay, so come on, please. When you look at the degree of precision, okay, and find it anywhere else, you're not seeing it anywhere else. Floor pivot numbers ain't going to deliver this level of precision. Okay, it's not there, folks. Supply and demand ain't going to do it either. But now watch what happens when we trade outside the band of this range. Notice we're probing below it here, but it's only going one standard deviation of this inefficiency with that low right there. Remember, go back to it and look, see? Look at it. It's controlled. It's only allowing one standard deviation outside of this when it went lower. I'm not interested in seeing it go below that low because I don't think it's going to do it. Why? Why was I interested in only getting out when it went down here? Why was I doing that? Because this inefficiency told me that this one standard deviation down here is about as far as it'll go once it trades to my target 3. Look at the video from last night. Okay. So once we get back inside of this inefficiency that's in purple, then I can start looking at the quadrants, the consequent encroachment, and the high and the low of the actual inefficiency. So you can see the low of the inefficiency here. Again, that's this candlestick's high. It's supporting it here, rallies up to upper quadrant, trades back down. It trades just outside of it here, but then goes right back into the middle and starts consolidating around the consequent encroachment or the midpoint of that purple area. Then the market trades one more time lower, and now it's allowing price to go outside the range of this inefficiency because it's it's enticing. It's luring traders to go short, and it's probing for liquidity below this low, and anything that's around here, they'll probe at and try to see if they can get that. But they got a short-term low here. They worked below that and then rally back up inside of that purple shaded area, which is the first displacement in the midnight opening range. The market rallies back up, trades to the high of the opening range at midnight here, then back down to consequent encroachment. Consequent encroachment, that's the red level, which is essentially just half of the purple shaded area, which is this inefficiency. Now, think about it. These are all rule-based ideas, okay? It's not contrived. It's not conjecture. It's not just pulling things out of randomness. These are things that I want you to go back and look at your own charts, okay? Just watching this video and being frustrated saying, there's no way, this is too complicated, I don't know what to do with this. The information that you're going to glean by going back over old data, old price moves is going to be astronomical. Like, it's going to get your gears turning, and you're going to be looking for these types of things and how it's influential going forward. So we get to the low of that inefficiency again here. What time of day is that? It's 2:41. That's London open. You want to be trading the London session. ICT, can you please do a London session? Can you talk about the London session? I'm doing it. I'm doing it. It's right here. This is the stuff I was doing with pound dollar, euro dollar, and I was smoking the Forex market. I was smoking everybody else out there in their bull crap that they believe that causes markets to go up and down. Because this stuff works in Forex too. Think about it, folks. You're getting to see what really is going on behind the facade of just technical analysis. The source code is being revealed right here. Right here. You can't escape it. It's right in front of you. It's been hidden from you all this time because you're not looking for the things that reveal it, because its author never talked about it. So we're looking at this rallying higher. We took this period of short-term highs here. That buy side was taken here. And then where's it go? Right back down into that first displacement in the opening range at midnight. Creates a short-term low. It trades below it again and goes right to the lower quadrant. Look at that. You can't get any plainer than precision. Look at that. Look at the low. Okay, look up here. Look at this value right here. Okay, keep your eye on that. Right there. Okay, see that low right there? What's that low? 21,705.50. Now watch, ready? We're going to take our time travel way back here at this random candlestick that was just picked out of thin air, right? What's the value of the lower quadrant? 21,705.50. Folks, Gann, Wyckoff, all these jokers from the old days, okay, that looked at charts and they pointed to things and they said, this is what makes the markets go up and down. And they only explain things in hindsight. I'm giving you things that's going to predict the future, and it's going to continuously predict the future. And I don't want you to take my word for it. I want you to go back to your charts and look for these signatures because I put them there for you to see all the time. Time. Emphasis on time. Stops right there because of selling pressure was abated and now buying pressure came in. Come on. It's not what's going on, but it's a wonderful fairy tale. So the market does what? What is it going to do here? What's it going to do? It delivers on 3:30 macro. In London session, go back through my Forex lectures. I tell you very specifically at 3:30, that's your sweet spot. Don't take my word for it. Do not take my word for it here. Don't just say, well, ICT said it in this video on January 7, 2025. No, 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 no. Go back through my lectures in the 2016, 2017, and listen to what I'm talking about. Listen to the old lectures that I did on Twitter, in Twitter Spaces. 2 years ago, I talked about first presented fair value gap, just casually mentioning it. The astute trader, the apt pupils, heard me say it, and he took notes. And he said, what's he talking about? Let me go in there. And then all of a sudden, boom, they could see it. I dropped the breadcrumbs for many years. But if the person that's sitting down and watching my video or listening to me lecture, and they get drowned by the depth in the word salad that you think I'm putting out here, I'm not talking to hear my own voice. I'm talking to teach you. But I'm also teaching in a way where only those individuals that really want it and deserve, because of their work ethic, they're going to get it. I'm not interested in creating 1, 2, 3, copy me. Here's your plan, and there it is. Go run and make money, make books, sell courses, and be a mentor, and sell mentorships for $1,000 to get in, and never have to prove that you're a trader. Now, come on, I'm not putting people in business like that. So at 3:30, the market starts to run away from lower quadrant of the first displacement in the midnight opening range. The market rallies aggressively up to some random projected level, negative 0.5, and then creates a retracement, makes a higher high, fails to take out the high, and then we trade back down into the first displacement again, stops dead end at a high at 5 o'clock. Now London session is done.